Let's now get into our first conversation for the day. And this is in regards to that proposal by Kenya's government, which is looking to cut down corporate tax in a move to lure investors. What implications will this have? We are now joined live by Ronny Chokaa, Research Analyst at Genghis Capital Investment Bank. Many thanks, Ronny, for making the time to speak to us. And clearly, the Kenyan government is firing from all cylinders, hoping to see a chance to bring back in investors. But what are the economic implications of this for the local farms?
Thank you again for having me on your show. So we're looking at the medium-term revenue strategy published by the National Treasury, and therein it lays out a set of tax reforms aimed at enhancing the fiscal space. Just to put into context, we are coming from a scenario where the revenue to GDP ratio is coming at 14.1%, whereas the sustainable target should be 17%, and our Vision 2030 ratio target should be 25% actually. So we are actually coming from a position where Treasury is looking at how do we boost our revenue basket? And I think now lowering the tax revenue ratio, or the percentage levied on corporate firms, both resident and non-resident, has become the imperative. So they're looking at lowering the tax rate, the corporate tax rate to be specific, from 30% to 25%. And they're looking to achieve a number of strategic objectives from this initiative. Firstly, they are looking to attract foreign direct investment flows into the country due to the favorable tax regime. You are aware that the Sub-Saharan African average corporation tax rate is at 29%, while the global average is at 23%. So if we lower to 25%, we are definitely attracting more FDIs into the economy. And not only to mention, we are also leading to faster fixed capital formation and newer jobs coming on board. So this move, if implemented, should lead to increased output over the medium term. Also, they're looking to increase the compliance rate by lowering the tax from 30% to 25%. They're looking to increase the number of compliant firms, or the compliance rate, from the current 70% to 90% by Vision 2030.
Quite a comprehensive analysis there, Ronny. But looking at the road ahead for the Kenyan economy, we've seen the Ministry of Finance trying to see how best it can tap into new revenue lines. Is this an aspect that can be sustainable, or is just a short-term measure by the government?
When you look at a move such as lowering tax rates, the very essence of tax rate reduction is to expand the economy. It is an expansionary policy by its operational mechanism. So by lowering the tax rates, you are achieving a number of strategic objectives. You are not only increasing the compliance rate, but you're also enhancing your revenue basket. And people may wonder, doesn't the Laffer curve show us that with every marginal reduction in tax, that the returns or the incremental contributions from that move will be to reduce the total tax collected? But research studies will show you otherwise, because thinking of the additional compliant firms that will be paying the new 25% tax, you are encouraging informal companies to come into the formal economy, and thereby on a broad level, we are enhancing our revenue basket as a result. So I can't really say that it's a short-term attractive or short-term incentives, to put it that way. What I'm looking at is strategic positioning of Kenya as an investment hub in East Africa.
And we've seen, of course, the President Ruto administration cherry pick some of the areas that they would want to expand. And Looking at the big picture, of course, as we lower the tax rate, if it goes through, perhaps which sectors are we forecasting a lot of investors putting their money on?
Thank you. So one of the other reforms that this medium-term revenue strategy is proposing is to scrap off some of these preferential rates offered to specific sectors. We had areas such as special economic zones being offered preferential tax rates of as low as 10%. So the Treasury, on the other hand, is coming in with a compensating change. So while it's reducing the corporate tax rate by 500 basis points, it is also removing the preferential tax rates on other sectors or preferential rates to incentivize activity in specific sectors. So by levying a standard 25% rate, they are looking to make an equitable tax rate across the spectrum. So if you look at agriculture, if you look at financial services, if you look at hospitality and tourism, all these sectors are, from how I look at the Treasury strategy, going to be subject to a uniform tax rate, in my view.
Interesting indeed. And just to get your quick parting shot, in terms of the practicality of implementation of this tax reduction proposal, what are the timelines we should anticipate by the time it will be sailing through or not?
So the medium-term revenue strategy has been prepared in alignment with the medium-term plan, number 4, running from 2023 to 2027. So the revenue targets that I gave earlier of having a revenue to GDP ratio of 25% by 2030, they are looking forward to take the tax revenue in specific, the tax revenue to GDP ratio to 20% by 2027. So that will be the check mark by 2027. So they are going to be phasing in these developments on a fiscal year basis rather than a one-off implementation. Yes.
All right. Quite some great conversation there. Many thanks, Ronny Chokaa from Genghis Capital Investment Bank.